Hey Bill, how are you?
I'm doing well. How are you, Bobby?
I'm doing well, thank you. Hey everyone,
That's
my name is
good.
Bobby Taruk with. Thank you. Hey, hello everyone. My name is Bobby Taruk with Keller Williams Premier Properties. Team Taruk here, just outside of Chicago. With us today is Bill Pendley.
Hi
Bill,
there. How are you?
I'm doing well, thank you.
That's good. That's good.
Hey, I wanted to right now. Uh, our interest rates are really pretty high. I'm not sure how much it is. I don't know if you've checked lately, but how much is it right now for mortgage rates?
You know, uh, it's an interesting time. I always say this on my calls. It's an interesting time, but it is. I
Hmm.
mean, we're moving in a direction that we haven't seen for a while. So I think you're probably looking at low sevens on a 30-year fix, mid sixes on a 15-year, but low sixes. I mean, so we're looking at times that are kind of making people feel a little uneasy, if not a lot uneasy. So
Hmm.
it's just one of those times where us as professionals that are on the main street level that know how to navigate through this, are on calls like this on a daily basis, if not more than once or twice a day, helping people understand what's actually going on with the market. And I think that's
Right.
why I like getting on these calls, because there is an opportunity. I think when you see rates move like this, market is shifting. Um,
Hmm.
you're not hearing as many appraisal gaps, inspection waivers. You're actually seeing like the art of negotiation come back into play again. So that's a good thing. There are multiple offers out there, but at the same time, I think these are opportunity moments for people. And the reason I think that is that when you see what's going on with inflation, you see the inflation rate go up, mortgage rates follow that.
Right.
In what they're doing, the feds, the feds are doing is they're trying to reduce that. So they're taking everything possible, to try to reverse that inflation rate. And the last time they met, we saw the CPI numbers come out, and once again, the inflation rate went up. So we saw a
Hmm.
major reaction with regards to rates on that. But the hope here is that the rates will come down. So if you're a buyer out there waiting, sorry, I'm just kind of going
Yeah,
off
yeah,
on.
go ahead. Yeah, go ahead.
If you're a buyer out there waiting, and I think you and I both listed the Airbnb, we heard this recently that there's going to be another demand that's going to come out. So you're going to once again get into a feeding frenzy of people trying to capture those lower interest rates. So it's once again going to see a demand come back. To what
Right.
extent, we don't know, but I think that that's right around the corner once those rates come back down. So
Hmm.
what I mean by that, and going back to the beginning of our conversation, yes, rates are high, but there's ways to kind of give you a little bit of breathing room for the short term, and
Hmm.
then we can take advantage of a no cost refinance and settle into a nice interest rate. So the motion right now is not as high as it was 3 or 4 months ago when people were overpaying for properties and going into a property with a line out the door like a Portillo's restaurant.
Right.
So I think we're seeing an opportunity, but the problem is that we're fighting against the media channels. In fact, I actually went and I said I don't usually remark off of any headlines, but I couldn't help myself. I saw that um, a headline from, I think it was NBC, that they said that lenders are resorting to higher risk loan products to try to get people into these a different option like the arms and 2-1 buy downs, and it's just way off. Like you don't, they when you
Hmm.
don't understand what's going on with the market, they start throwing these headlines out to get clickbait, and it's frustrating for us. We're trying to really
Yeah,
help
absolutely.
people out
Hmm.
with the American dream.
Yep, absolutely. So yeah, it's still we just reviewed this past Tuesday the statistics on the different counties. So DuPage has been resilient against the higher interest rates. There's quite a bit of market activity. Some of the counties, I can't remember which county it was, that on a per square foot basis cases, the pricing, the ones that are pended under contract, have gone back to January 2021 level. So to your point, if the home is priced correctly, they're still going to sell. Now, it may take additional days on the market. There was one recent story, really quick, that Vince, one of the agents in our office, he had a listing in Amherst, and I saw he did a video on it, and the price point, I believe, it's above 700. And we had just had an office meeting this past Tuesday, and I asked him, "Hey, how did your Amherst listing go?" And he said he's under. There's one offer on it, and he was expecting another on that property. So if the home is priced correctly, it's still still going to be a demand on it. Looks like there are some stories in the chat when we did a Zoom session with Pete that the listings are still getting, some are getting multiple offers. So, but really the core of the conversation I wanted to talk to you about is if the playing field is level. As an example, if there are 3 homes in the exact same subdivision, condition is very similar, features are very similar, it's priced correctly, all things being equal with marketing, assuming the marketing is on a level of playing field, what can sellers do and what can listing agents do to further incentivize the buyer? So let's talk about that, leveraging your product line.
Yeah, there's 2 that come to mind. And it just depends on price point too. But going back to the initial rate question, jumbos are actually pretty decent. So that's a whole different. When you said that $700,000 listing, I thought, oh well, no, it's still under the conforming or the jumbo limit. So that's interesting. It's good though. I mean, it's good that there's buyers out there that are still putting offers in, even if rates are higher. I think in that price point too, you have a little bit more cash to work with too. So you might be able to utilize the buy down, or also too the demographics there too. They may know that the buy down is an option to go with, and maybe they're studying the market. Who knows? But that's really good. And the other thing about, obviously we know this, is that the inventory just isn't there. So this question, when it comes to really getting creative with negotiating, if your sellers are willing to do this, there's a couple things they could do. They could actually do a buy down. There's a 2-1 and 1-0 buy down. What that specifically means is that they're putting money towards lowering that interest rate for the first 2 years on a 2-1 buy down. Second year goes up to 1% higher, and then it goes to the current standard rate. So you have the 1-0 buy down, which is basically taking that current interest rate and dropping it 1% lower than what the market rate is. What I like about that product though is that if you're kind of looking ahead and looking at the turn of this shift, if we see an opportunity where there's a refinance, that money that you use for the buy down expense could actually be, some of it could be reimbursed. So it's what it is prepaid interest. That's kind of the way to look at it. So what the lenders do is they'll put that money into an escrow account, and they'll just take off a portion of that interest on a monthly basis and pay for that difference of interest rate. So first year rate's going to be quite a bit on a 2-1 buy down, is going to be quite a bit more interest, obviously, than the second year. So there's a little bit more money that's being used to put into that 2-1 buy down on the front end. But like I said, if 6 months from now, let's say that rates do drop down to 5s or 4.5%, you've just won, so you've been able to kind of get a little bit of a break as far as monthly payment. And if the sellers are willing to pay that, that's even better, because that's just money that you've gotten back from the negotiation. So if there is an opportunity where the seller could actually say, listen, we want to sell our house, we're not getting a lot of action on it, it's been on the market for 3 or 4 weeks, let's put out there a 3%, either closing cost credit or buy down, or however you want to put it. But essentially that 3% would be used to pay for closing costs. And so you could put that money into a buy down expense as well too. So it's a great leverage tactic for a seller if the seller understands kind of how that works, and if it's going to attract more buyers, great.
Yep, absolutely. Yeah, we've talked about this as a strategy maybe even a month and a half ago now. Have you, I personally haven't executed it in practice, but I know you work a lot of KW agents as well, or even other agents outside of KW. Have you
Mhm.
seen it in practice, and do you have any success stories that you can share, if you
Yeah,
don't
I
mind?
have. We have two that are going on right now. One's a 2-1 buy down, one's a 1-1 buy down, or 1-0 buy down. Sorry.
Hmm.
So it's just a matter of how much money that they want. Either the buyer has that they wanted to put up for that buy down expense,
Hmm.
or a seller is willing to do it. So I actually locked in two in the last 2 or 3 weeks that wanted to take advantage of it.
Okay.
So
Uh, yeah, segue to that topic is it, are you seeing typically that the seller initiates that, or is it typically more so that the buyer is so educated that they actually ask it first? So what are you seeing? Who would pull the trigger first?
yeah, well, this is what typically happens. Somebody that's been, and this is just the nature of the beast right now. When I
Hmm.
say what the interest rates are, I hear the response, "Oh, like deflated sales."
Right.
So my hope is to provide a hope for people to say, "Listen, let's pump the brakes a little bit. Don't let it steal your hope of buying a house.
Hmm.
Let's really kind of navigate through this." And walk through on a visual perspective. Like, I don't like just throwing numbers at people like verbally like this. I like to give them a visual. And once you give them the visual on what it looks like to do the buy down, explain it in
Hmm.
layman's terms, not throw any high level like terms at them. But if you can
Hmm.
explain it, I always say it's kind of like we're trying to explain our calculus to a third grader. So if you can put it down in layman's terms for somebody to understand, they'll get it and they'll go, okay, that makes sense, especially where are with the inflation rate. So
Hmm.
that's kind of the response I've been getting. It hasn't necessarily come from the sellers yet, although I do have some agents that have some listings that are sitting a little longer. So they're trying to get creative with, putting marketing out there that will actually entice people to really come through the doors and maybe put an offer in, because I think certain price points are seeing those rates go up, and it's kind of putting the fear in the market a little bit.
Yep, absolutely. Interestingly enough, right before this call, actually, I just scanned Facebook, and I have a Facebook friend. She's out in Washington, D.C., and she's a mega agent. Her team does quite a bit of volume. But I
Mhm.
was surprised that actually on the social media post, it already listed in there the exact amount it could be used for. They were offering it for closing costs or a temp 2-1 buy down.
Mhm.
So it can actually initiate, or the seller can initiate it with the permission of the seller, of course, and the listing agent
Right.
can advertise it on social media, and I would highly likely make it visible in the broker remarks that's syndicated to other websites like Zillow. So
Right. Yeah. I mean, I think back in 2008 when listings were literally sitting longer, I remember seeing they were offering cars.
oh wow.
I mean,
Hmm.
it was crazy. I mean, it was like I couldn't believe some of the stuff, the tactics I saw being pulled for some of the,
Hmm.
some of these listings. But is there a way that I could share
Yeah,
screen?
yeah, yeah, should be able to. It's the icon between the camera and the plus person icon.
Gotcha. Okay, so I can show you a visual. What the difference. And the other thing you want to mention too is that the buy down, the 2-1 buy down, and also, and I'll just click on it really quick so we can get there. But
Yeah.
can you see this?
Uh, do I have to manipulate that? Give me a sec. Yep, it's being shown on the screen.
Okay, cool. Perfect. Okay, so when you hear buy down, I think we're actually getting a 3-2-1 buy down
Hmm.
up here soon. Your job is to give you options, and you pick the one that's best for your family. But when you look at the difference on a to remember is that when thinking about a 2-1 buy down, and that means that rate's going to go up to the current market rate, whether it be within 2 years or 1 year. A buy down, a permanent buy down, is essentially taking points and you're driving that rate down as low as you can with money. For me, I'm not a big fan of that because that's lost money. So if you're at a $400,000 loan, if you look here where you're down at the permanent buy down here and you're at 7.125 and you take 1% of that loan amount, that's driving you down to 6.625, and 1.5% is driving you down to 6.25, which isn't bad, but this is a percent. This is what you're seeing across the board when you get online and look at a lot of the online lenders.
About 0.5%. Yep.
Yep. They're driving it. They're saying, here's your interest rate. Their interest rate looks lower, but then you have extra costs. So when you think about that percent, that's 1% of the loan amount. So if you're at a $400,000 loan, that's $4,000 that you're paying for the 6.625. The reason I like the temporary buy down is because what happens if the rate goes down to 5.5% or 4.5% in the next 6 months? You just lost $4,000 and it goes out the window. Not necessarily, but you're not going to recoup that cost as much as you would on this short-term loan.
Yep.
So if you can see here, so if you can see here, here's kind of like the breakdown of what it looks like. How much? And this is just a quick scenario. This isn't where rates are, so it's just like an estimate. It's only for example purposes, but here's to look at what it would look like with a 7.125. There's your, after the third year, that's what it would be. And there's your monthly payment. This is just principal and interest. Okay.
2.4.
The savings on that first year at 5.125 is going to be $466 a month. This is very attractive for people, especially if you do kind of understand the market. And if we do see some relief with the inflation, this is a great savings up front, but here's the interest for that first year, right? That's coming out of that $8,400. So on the, on this scenario, I think it was, I forgot what it was. Let's see. I don't know I honestly don't know what loan amount that scenario was on, but this is just giving you an idea. So $8,400 for that. And then there's the second year interest. So it's less the second year, but there's also less of a savings there too. And then you go back up to this. So the hope here is that you're going to be able to refinance that. And really it's just the same thing here, less cost. So let's say the buyer has an extra $3,000 laying around. They want to lower their payment down to low sixes. They could do that. And then the buy down obviously is much less of a savings and more money that you're not going to necessarily get back on that point system.
Yep, agreed. I really like the part that actually the one thing that I wasn't really cognizant and aware of was actually when there's a refi in year number 2, that whatever was not consumed in the buy down cost can actually go back to the buyer and can be applied to the principal. That's what I understood it to be.
Yeah, so that's where I was watching a lot of people describe the buy down, and I'm like, for a while there, I was like, it doesn't even make sense. Why would they? And I was doing like 10-1 arms because they're about 0.5% lower. 7-1. I didn't feel like those were risky, even though the article said that arms are risky. But if you're a first time home buyer, your average life expectancy of living in that first home is about 6 years. So I felt like a 7 and a 10-1 arm were a pretty safe play for that, and not charging any points. But when it comes to a buy down, when I found out that you could actually get a portion of that money back, I thought it was a slam dunk, option for people.
Absolutely.
Because it's not necessarily lost money if you look at it that way.
Yep, absolutely. I would imagine that's not taxable income, is it? Is that deemed as taxable income or no?
That's a good question. I don't think so.
Okay.
Because I don't think, no, it wouldn't be because it's a cost of the loan. So, and it's not, you're not making money for anything other than just trying to save on closing costs. But am I still sharing or no?
You're still sharing, so I cannot.
Oh, here you go.
2 frames.
Stop sharing. There you go. Okay. Sorry, I'm still learning the tech part of this one. But
Yeah.
yeah, I just think that I would, if I was in the market right now and my rent rates were going up like crazy, which they are. I just think it's an opportunity. I think it's an opportunity, in a lot of senses. You mentioned one of them.
Right.
It's a tax break. How to get away from inflation is invest in yourself and invest in real estate.
Yep, absolutely. So anything more exciting products coming from your firm? I'm looking forward to your event that you will have at actually a they function as a GC.
Yeah.
Did I get that correctly?
Yeah, so we're doing an event coming up on November 3rd, and this is another amazing product. I think if you're an agent out there,
Mm-hmm.
I think I would definitely make it to this event on November 3rd. It's at FBC Remodel. They have a really great product, great system. They have designers in their company. It's right downtown Naperville, right across from Centennial Beach. So we're going to
Okay.
go in there we're bringing in our president of our reno department. So he's going to be coming in there and giving you any answer you need on the reno. He knows it like the back of his hand. This is his thing. So his name's Sean Thompson, and there's just an amazing opportunity for maybe let's say you want to be in Naperville, right?
Mhm.
But the price point's not allowing you to be there. Number one. Number two, the inventory, or number three, just that there's not an option there. But there might be that option if you find something that has good bones and needs some improvements. I just closed one recently where the guy was buying a $467,000 townhouse in St. Charles and said that he needed about $100,000 of improvements to make it his own, and so nobody was touching
Right.
that listing. And then, how we did it was we had him get a contractor, put a bid in with the appraisal after he wrote the contract, and my jaw hit the floor. The value came in at 600,000. He goes, well, can I still put 5% down? I go, yeah, you can still put 5% down. So we're giving him money to make the house his own. So this is one of those things where it is such a great play in this market. So if you're out there with buyers and they go, I love the house, but I don't like the way it looks. Wait. There's still an option. Even if you're putting 3 or
Mm-hmm.
5% down, we can get you into this house. So as an agent, help them out with looking past the wall, maybe get them in with like one of the contractors or get them in with FBC to do amazing job there. And then boom, you got yourself, you're looking like a hero by the end of the day. Because I also saw him on he posted the other day with a real estate agent that had a buyer that wanted to buy in a certain area and kept looking. I think it was in New York, but kept looking at different areas, just couldn't find anything and didn't want to be in those other areas. They weren't as safe as where this other place was. And then this guy found this place that needed work, and they wound up making it work, and also putting their own touch on it with the remodel. And I think the other thing too
Yep,
is I think you
absolutely.
saw this with Barry Habib. This, I think it was either yesterday or today. The building
Mm-hmm.
starts are down. So if the building's down and you have older houses that need some money, like St. Charles is a perfect example. On the east side of the river, a lot of old money's over there. So this type of product would be a great option for people.
Yep, absolutely. So
But we
quick
have
question on this one.
just a, yeah.
So there's the acquisition costs, and then the renovation loan. What's the life or the term on that loan? Is that typically a 5 year, or what? Does that
No.
just function as a HELOC, or what is that like?
Nope. So it's one loan and it's a 30-year standard fixed, So what happens is we do the future value and do the loan based on the future value of the house. So like for
Oh,
instance, this guy was at
so
7, and so we just did 6. We looked at this house is being bought for 600,000. He's putting 5% down, and and using the future value as the money to pay for the expense there. So that's his loan amount. So we give the contractors the money after he buys. So we close it in 30 days. So he, in essence, right now, he closes in 30 days ago, and he's remodeling while we're sitting here, getting ready for Thanksgiving. Makes sense.
And then it's more like a construction loan. Then it goes to, right?
Yeah, the money will be paid
Obviously.
out based on the work that's being done. So after, we have a whole department that's taking care of that right now. So I'm at this point, unless there's something I need to be involved in, it's a closed loan, and and obviously I want to be there for the customer if they have any questions or anything like that. Then we'll make sure to help them out. But other than that, no news is good news, and he loved the product. I mean, when I explained it to him, he could not believe the product was even offered at that. And it's a little bit higher interest rate, not much, maybe like an 8% or so. I think I'm back on. But yeah, but it's a great product for anybody right now. The other thing I want to mention too is so we have 3 types of renovation loans. We have the it's called home style, and that's the conventional version. And then we have the FHA 203K limited, which I think it gives you like 30 or 35,000. And then it's more like a streamlined process. And then you have the full FHA 203K loan. And then the last one is the VA loan. I don't know of anybody else that's doing a VA renovation loan. So if a veteran goes and buys a house for, 200,000, puts no money down, boom, all of a sudden, I think you can get like $25,000 on top of that for improvements. One of the reasons I like this, another reason I like this product is that you could, as a listing agent, let's say you have a dilapidated property that's not going to be warrantable, meaning that warrantable based on like health and hazards. So like if you had mold or, water, like I had a deal fall apart because the appraiser caught it even on a conventional deal. Nobody's going to be able to finance that house because of Freddie and Fannie. Well, we would have been able to do it if the client didn't back out of the property. I went back to the listing agent, who was a KW agent. I said, listen, we can still do this. Let's market it as a renovation loan, because the only thing you're going to have on top of that is a cash buyer at that point.
Yeah. Yeah, that's a good plan. That's a good scenario. Absolutely.
Yeah.
So sounds to me that there's really quite a bit of innovative products that you can help people regardless of what seems to be impediments to closing the deal and the buyer acquiring the property.
Yeah, this is one of those markets where you're going to see a filtering out of the business. So if you're not educated on your products and you can't get creative, then you may not be in the business very much longer. And I say that with soft gloves too. I'm not trying to be mean, but this is where experience is going to pay when you're talking to your real estate agent like yourself or the loan officer. You want to make sure that the person knows really kind of how to work a deal. And the 2-1 buy down is a deal that has not been talked about for 20 years.
Right.
Nobody really did them.
Our rates have been, precisely.
Exactly. Yeah. So this is one of those old products that come back and they surface again. And that's just stuff that, back in the day, I had to actually relearn it because back in the day, there were completely different types of products. There was a lender paid 2-1 buy down and all this stuff. But now it's just a whole different product, but it's the same concept there.
Yep, absolutely. Okay. Well, Bill, thank you so much for this conversation. I appreciate you. How can people get a hold of you? I will put all of our contact information still in the comments and description section, but how can people get a hold of you?
Yeah, the best way to get a hold of me is my my cell phone number, 630-330-5626, or you can link up to me on social media. You can see my name there, Bill, the mortgage guy, but it's the. So I was just playing around with a Chicago little feel to the name there when I put it out there. But yeah, LinkedIn, Facebook, Instagram. I'm always on Instagram, so feel free to reach out at any time. And I'm always putting videos out too. Right now, trying to put those reels out there that are like 30 seconds that'll help explain products like the 2-1 buy down. And if you have any questions on anything, just give me a call.
Yep, absolutely. So my name is Bobby Taruk. I am maximizing my video screen here. If you haven't subscribed to our YouTube channel, smash that subscribe button, and hope to see you again. Thank you.
Have a great day.
Thanks.